When an option contract is about to expire, you should watch out for pin risk. Pin risk occurs when the underlying stock price is trading at or near a strike price at expiration. This scenario can cause uncertainty around whether an option contract will expire in the money or out of the money. This is important because it can determine if your long options are automatically exercised and if your short options are likely to be assigned to you. Fortunately, pin risk isn't something that happens all the time, but it's common enough that you'd like to keep an eye on it. One way to potentially identify a stock that might have its price pinned at expiration is to look for a strike price with large amounts of open interest and trading volume. You can do this in WebBroker using an option chain. If you look at this option chain, the $185 strike is near the money and has significantly more volume and open interest than other strike prices. So it's possible that the stock price will pin at $185 at expiration. This phenomenon is like a game of tug of war. You have two groups of traders that want to pull the stock price in their favor. Traders who benefit from the price going higher may buy more shares to raise the price, while those who would profit from a lower price may decide to sell shares to force the price down. And we're not talking about retail traders like you and me. These are often large institutional traders. This back and forth is often what keeps the stock price pinned. Now let's look at some examples to see where the risk is for retail traders like you and I. Say you bought a $185 call for $100. Your maximum potential profit is unlimited, and your maximum potential for loss, well, that's $100. The stock price is currently pinned at $185, and it's 15 minutes before the closing bell on the last day before expiration. If you don't close out your option before expiration, then one of two scenarios can happen. One, the option expires worthless and you lose $100. Or two, the option is exercised, meaning you buy 100 shares of the stock at $185, increasing your maximum potential for loss from $100 to $18,600. That's a big jump. If you're not comfortable with this potential added risk, you need to make sure your option isn't exercised. The easiest way to do this is to close your option before it expires. But you can also submit a do not exercise request with your broker. This request tells your broker to not exercise your option, even if it expires in the money. Moving on, let's look at a covered call seller's point of view. Say you bought 100 shares of a stock that was trading at $180, then sold the 185 call for $100, creating a covered call. Your maximum potential for profit is $600, and your maximum potential for loss is $17,900. If you don't close out the option before expiration, then one of two scenarios can happen. One, the option expires worthless and you take home a profit of $100. Plus, you still have your 100 shares with an unlimited maximum potential for profit and a maximum potential for loss of $17,900. Two, the option is assigned, meaning you're going to be selling your 100 shares of the stock at $185. You make the maximum potential for profit of $600, and now you've got no additional risk. Lastly, let's look at it from a naked seller's point of view. Say you've sold a $185 call that you've received $100 for. The maximum potential profit is $100, but your maximum potential loss is unlimited. If you don't close out your option before expiration, then one of two scenarios can happen. One, the option expires worthless and you make your maximum gain of $100 with no additional risk. Or two, the option is assigned, meaning you sell short 100 shares of the stock at $185. That way, you still have an unlimited maximum potential loss with a maximum potential profit of $18,600. So your maximum potential risk doesn't change, but your maximum potential profit goes up significantly. And you may be forced by your broker to close out the position by buying back your short shares at any time in the open market. From these examples, you can see the biggest change in your maximum potential risk is when a long option is exercised. So when your long options are expiring, keep an eye out for pinning. And if you're not comfortable with the potential added risk, consider closing out your options before expiration. That wraps up this lesson on pin risk. Happy trading. Have more questions? Check out the links to the right and in the description below.